There is a building in your city with reinforced concrete walls, bulletproof glass, security cameras on every corner, and a vault door that weighs several tons, and almost no money inside it. Not because it was robbed, not because something went wrong, because that is exactly how it was designed to work. The image you have of a bank, the one from every heist movie, every instinct you have about where your money goes when you deposit it, is a fiction, a comforting one, but a fiction. Banks are not warehouses. They never were. And what they actually are is stranger and more consequential than a room full of cash ever could be. By the end of this video, you're going to understand exactly what banks do with your money the moment it leaves your hands. The mechanism that lets the same dollar exist in multiple places simultaneously. Why that makes the entire system work, and what it makes possible when it breaks. This is one of those things that seems complicated until someone explains it clearly. After this, it's just obvious. To understand what banks actually do, you need to understand what problem they were invented to solve. Go back far enough, and wealth storage was a purely physical problem. You had gold. You needed somewhere safe to keep it. Goldsmiths, craftsmen who already had secure vaults, started offering storage. You deposited your gold, received a receipt, and could return any time to reclaim it. Simple. Logical. The money sat in the vault. The receipt represented it exactly. But goldsmiths noticed something. Most depositors never came back for their gold at the same time. People came and went. Some withdrew. More deposited. But the vault was never fully claimed at once. So they did something that changed the world. They started lending out the gold that wasn't being claimed, charging interest on those loans, earning money on deposits that didn't belong to them, while keeping just enough in reserve to cover withdrawals that actually arrived. They discovered that money could be in two places at once. Your gold was still in the vault, technically, but it was also out in the world, working, earning, building. This was not a loophole. This became the entire model. Every bank in the world today operates on this same fundamental insight that reserved money and circulating money can coexist as long as confidence holds and withdrawals stay predictable. Here is what your bank actually does with your money. You deposit $1,000. The bank holds a fraction in reserve and lends out the rest. That loan lands in someone else's account. Say, a person who borrowed $800 to fix their car. Their mechanic deposits that $800 into his own bank. That bank lends out the majority of it, and on it goes. Your original $1,000 has funded multiple loans simultaneously. The total claims in the system now exceed your original deposit by a significant multiple. Economists call this the money multiplier. Your $1,000 can become $5,000 or $8,000 in total economic activity depending on reserve requirements and lending behavior. This is not fraud. This is the designed function of the system. Without it, there would be no mortgages, no business loans, no capacity to build infrastructure faster than cash accumulates. But here is what this means for your deposit. Your bank does not have your $1,000, not in any physical sense. What it has is an obligation, a legal promise to return $1,000 worth of value whenever you ask. It can honor that promise not because your specific money is sitting somewhere, but because it has enough total liquidity to meet whatever withdrawals are likely on any given day. The system runs on probability and trust simultaneously. And then there is what banks actually do to generate revenue, because storage was never the business. Modern banks are financial intermediaries. They sit between people who have money and people who need it, extracting a spread from every transaction in between. The interest rate charged on a mortgage versus the rate paid on savings. That gap, called the net interest margin, is the engine. Your deposits fund loans at higher rates than you receive. The difference is the product. Beyond that, fees on every transaction, overdraft charges, foreign exchange margins, and wealth management commissions. And beyond that, for the largest banks, investment banking, trading desks, derivatives, securities underwriting. Your deposits provide the stable regulatory base that allows them to operate in those markets at scale. Your $1,000 is not in a vault. It is the foundation of an entire financial operation you never see. This system is extraordinarily efficient, and it has one catastrophic vulnerability: confidence. The fractional reserve model depends entirely on depositors not all asking for their money simultaneously. On any normal day, that assumption holds perfectly, but confidence is not always rational. And when it breaks fast. In 2023, Silicon Valley Bank collapsed in 48 hours, not because of fraud, not because of reckless loans. It had invested depositor funds in long-term government bonds, considered among the safest assets in existence. When interest rates rose sharply, those bond values fell. SVB disclosed a loss. Depositors, sophisticated tech companies with large uninsured balances, began withdrawing. Word spread through group chats and social media. Within 2 days, $42 billion in withdrawals had been requested. The bank could not meet the demand. The vault was empty, not because the money was stolen, but because the money was never there. It had been doing exactly what banks do with money, and when everyone asked for it at once, a model that worked perfectly for decades failed in hours. This is the design, working as designed, until it doesn't. So if banks are structurally this fragile, why does the system hold together as well as it does? 2 mechanisms. The first is deposit insurance. In the US, the FDIC guarantees deposits up to $250,000. This exists for one purpose: to prevent rational bank runs. If your money is insured, you have no reason to panic withdraw. The guarantee makes confidence self-fulfilling. The second is the central bank as lender of last resort. When a bank faces a liquidity crisis, the central bank can provide emergency funding, not to reward bad decisions, but to prevent one bank's failure from cascading through a system where every bank's deposits partially fund every other bank's operations. These 2 mechanisms transform a structurally fragile system into a practically stable one. They are the net beneath the tightrope. But they create a problem economists call moral hazard. If banks know they will be rescued when things go wrong, they have less incentive to manage risk conservatively. The safety net that stabilizes the system also makes institutions inside it slightly more reckless than they would otherwise be. Every major banking crisis in modern history has this dynamic somewhere in its backstory. The system is stabilized by guarantees that partially incentivize the behavior that requires the guarantees. So what does your bank actually do? It takes your money and puts it to work in loans, in investments, in financial infrastructure, while maintaining just enough liquidity to honor expected withdrawals. It monetizes the spread between what it pays you and what it charges everyone else. It operates on the assumption that confidence will hold, backstopped by insurance and central banks for the moments when it doesn't. It is not a warehouse. It is an engine. Your deposit is not stored, it is deployed. And this matters to you directly because understanding what a bank actually does changes how you evaluate every product it sells you, every rate it offers, and every assurance it gives you. When a bank pays you 0.4% on savings while charging 7% on mortgages, that gap is not a coincidence. It is the product. You are the raw material. Someone else is the customer. When a bank calls your deposit safe, they mean the number on the screen won't change without your permission. They do not mean the money is sitting there waiting for you. It isn't. It never was. And now that you understand what banks actually do, the only question worth asking is whether you're getting a fair return for the role you're playing in their system. Historically, most people aren't. But most people also never thought to ask.